This is Nightly Business Report with Bill Griffith and Sue Herrera.
Monday rally. The Dow soars more than 300 points. Is the bull ready to make a run to new highs? Or is this as good as it gets?
New wealth. Homeowners are sitting on a record amount of cash. So why aren't they tapping into all of that equity?
Planning for retirement? Why working a little longer can have a big impact on your nest egg. Those stories and much more tonight on Nightly Business Report for Monday, July 9th.
And we do bid you good evening, everybody. Stocks rallied to start this week. The advance was broad, the mood was upbeat, and it was enough to push the Dow back into positive territory for the year, thanks to a notable move higher in bank stocks, which had their best days since late March. And in turn, that helped to divert attention away from fears of a global trade war, at least for today. Here are the final numbers. The Dow Industrials up 320 points to 24,776. The Nasdaq added 67. The S&P gained 24. Bob Pisani has more now on today's sharp move higher.
It was a strong start to the week with the Dow rising more than 300 points. Why the rally? You know, for weeks, stocks have been on edge over worries about a global trade war. Over the weekend, there was no escalation of the trade war rhetoric, and that may be enough for at least a short-term rally. China also reiterated its pledge to open its markets more, and the Chinese stock market rallied more than 2%. In the U.S., cyclical stocks like industrials and materials and technology all rose, while banks had their biggest day in several months on higher rates and the prospects for better earnings. Remember, J.P. Morgan will kick off the second quarter earnings season on Friday. Defensive names that have done well recently, like Merck and Verizon and Coca-Cola, Procter & Gamble, all declined. Another positive catalyst was Friday's jobs report. Remember, that added 213,000 jobs in June, beating expectations, but wage growth was very modest. Now, that kind of Goldilocks scenario makes traders more comfortable that the Fed may not embark on an aggressive campaign to raise interest rates. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
As Bob mentioned, next comes earnings, which start in earnest on Friday. But could profit reports and, believe it or not, trade actually help the bull case for stocks? Mike Santoli takes a look.
Trade tensions have been seen as a drag on the stock market this year, but living with trade policy friction for several months has actually helped the market backdrop in a few ways. And along with the impending corporate earnings season set to show stellar growth, this could set up Wall Street's bulls for another shot at stretching a rally toward January's peak levels. How have global trade disputes been recast as a positive? Well, for one thing, anxiety over trade has pressured areas of the stock market most exposed to big-ticket exports, such as industrial manufacturers, which has left the sector nearly 10% off its record high. This has made that crucial group appear far less expensive than just a few months ago, compared to earnings that are on track to grow nicely through this year. Wariness over trade has also compressed long-term bond yields, with the 10-year Treasury now below 2.9%, which relieves borrowing costs and makes equity valuations look a bit better versus bonds. And the trade issue and its threat to global growth has been among the factors leading some economists to predict the Federal Reserve might ease off its tightening campaign late this year. Finally, all the aggressive trade rhetoric has drained away some investor enthusiasm. Surveys of retail investor sentiment now show a 3-month low in optimism, and cash has steadily been pulled from stock funds in recent weeks. Such subdued investor sentiment readings often serve as contrarian signals that leave the market poised for relief rallies. Meantime, earnings season kicks off in the coming days, which could refocus investors on strong corporate results in the wake of the tax cut and sturdy domestic spending trends. None of this means the market will decisively escape the trading range that has prevailed since February. Rallies lately have stalled well below the January peak, and seasonal factors will begin to turn negative by late July. Still, there's a chance that the market has made a tentative peace with the trade war story, opening a lane for the bulls to make a bit of a midsummer run at the wintertime highs. For Nightly Business Report, I'm Mike Santoli.
Now, despite today's rally, there are a number of Wall Street firms that have become very cautious on stocks. Today, for example, Guggenheim Partners called this latest rally the last hurrah. A Morgan Stanley strategist says it's time to go full-on defensive. Barclays says not even small caps are immune to any trade war fallout. And recently, Morningstar Investment Management Group told investors to brace for another lost decade for stocks. Now, one of the authors of that Morningstar report is the group's president and chief investment officer, Daniel Needham, and he joins us tonight. Dan, good to see you again. Welcome back.
Hi, Bill.
I remember the Dow touched 1,000 for the first time in the mid-60s. It pulled back, didn't see that level again till the early 80s. The NASDAQ hit 5,000 in 2000, pulled back, didn't see that level again for 15 years. Are you talking about something like that happening again?
Well, how it actually plays out, we're not too sure about. We take a long-term view, but relative to history, the stock market price relative to, say, the earnings and the cash flows that it generates are very high. And from this level, we think that returns for investors that hold, say, the stock market for the next 10 years and reinvest their dividends are going to end up with a low return, so low single-digit returns, which is, going to be low relative to history, and we think indicative of the high levels of valuation that we see in the market.
Yet we have an economy that seems to be firing on all cylinders. We have record low unemployment. I mean, the fundamentals of the economy look good. I know that doesn't always translate into stocks, but that doesn't you think, bode well for the stock market or contribute to higher prices in the stock market?
It's a good point, Sue. What I would say is that everybody knows that the jobs market is improving. We all see the unemployment figures. We all see the record levels of cash on corporate balance sheets, the high levels of profitability. There's a lot of positives. But, capital markets and stock markets are forward-looking. So prices reflect that information, in our opinion. The challenge is that when you get into these sort of later business cycle stages where you start to see unemployment very low, you start to see inflationary pressures rising, well, that's the time when investors tend to be the most optimistic. And unfortunately, extrapolation can be very hazardous to investors' wealth. Yeah. And so at these points, people assume the good times are going to keep going. But unfortunately, a lot of those positives are already in these very high valuation levels.
So what are investors to do with this information? If we're to have a lower than expected return for equities over the next 10 years or so, where do you suggest that they go to get the best return?
Look, I think it really depends on your type of investment strategy. For many people, trying to time the markets and exit the US stock market now would be very dangerous. And generally what we think they should do is just brace for lower returns. The challenge when you've had such high returns for the last 5 years and 10 years is that people start to think that's normal and they start to adjust their spending and their savings patterns. So we think, firstly, lower your expectations. I think this is going to be a more challenging decade for stock market returns. Now, for those investors that can take a long-term view and that maybe are willing to be more contrarian and separate themselves from the pack, there's value in stock markets outside of the US, particularly the UK stock market. It's unpopular, but it's also priced accordingly, so we think there's some value there. We also think there's value in emerging market stocks as well. At the same time, the yield for cash and short-term bonds is rising, so the alternative is much more attractive than it was, say, 2-3 years ago when cash rates were anchored around zero.
All right.
But probably the lesson from our perspective is, for many people, don't try to time the market.
So noted. Daniel Needham, the president of Morningstar Investment Management. Good to see you again. Thanks for joining us tonight.
Thanks, Bill. Thanks, Sue.
Fund investors, on average, registered modest gains in the second quarter. According to Thomson Reuters Lipper, the average diversified U.S. stock fund's total return during those 3 months was 3.7%. Bond fund returns were relatively flat, but they saw a lot of cash flow into them, more than $126 billion, according to the investment company Institute. Stock funds saw $58 billion in outflows.
Shares of Pfizer were in focus today after the president targeted that company in a tweet. Mr. Trump wrote on Twitter, "Pfizer and others should be ashamed that they have raised drug prices for no reason. They are merely taking advantage of the poor and others unable to defend themselves, while at the same time giving bargain basement prices to other countries in Europe and elsewhere. We will respond." Now, in response, Pfizer said prices for the majority of its drugs do remain unchanged. But last week, we did tell you that Pfizer had raised the price of some of its drugs, although it lowered the cost of others at the same time. Pfizer shares fell midday when that tweet was posted. By the close, the stock was up a fraction.
The Trump administration has decided to suspend key payments that are part of the Affordable Care Act. The payments to insurers help stabilize the insurance market. Experts say the freeze could increase uncertainty and drive up premiums this fall. The White House cites a legal ruling that tossed out the formula used to calculate those payments, calling it flawed.
Well, it's the first day on the job for the man in charge of that healthcare venture formed by Amazon, Berkshire Hathaway, and J.P. Morgan Chase. His goal? Nothing short of bringing costs down and changing healthcare as we know it. Meg Terrell has more.
It's a tall order. Fix healthcare not only for the 1.2 million employees and families of Amazon, Berkshire Hathaway, and J.P. Morgan, but also aim to create blueprints for better care at lower cost that can be emulated nationally. And on day one for CEO Dr. Atul Gawande, even the name of the company isn't known. Gawande has been referring to it as ABJ for its 3 founding companies. What is known, it's independent, based in Boston, and not for profit. Beyond that, some is known about the enterprise's mission. And from recent speaking appearances and previous writing in the New Yorker and elsewhere, there are some clues about how Gawande may seek to accomplish it. First, the goals. Gawande spelled them out recently at a conference in Aspen.
I get to have 1 million patients that I, as a doctor, get to add to my responsibility. And my job for them is to figure out ways that we're going to drive better outcomes, better satisfaction with care, and better cost efficiency with new models that can be incubated for all. That is a tall frickin' order. But, you know, what they're saying for me is resources won't be the problem. Human behavior will be, and achieving scale will be.
Gawande laid out 3 sources of waste in the healthcare system: high administrative costs driven largely by middlemen, second, pricing, and lastly, misutilization of care, what he said was the biggest contributor to waste. Gawande defined it as the wrong care at the wrong time in the wrong way. And it's the topic of much of his research and writing, including the 2009 New Yorker article that so impressed Berkshire's Charlie Munger that he sent a $20,000 check to Gawande sight unseen. The biggest knock on the surgeon, writer, and public health researcher as he begins this new venture is that he has never run a major health company or system. But Andy Slavitt, who ran Medicare and Medicaid in the Obama administration, argues instead that's a strength. Many, including Gawande, expect progress will take time, but say it's not only possible, but much needed, as healthcare now accounts for 18% of the U.S. economy. For Nightly Business Report, I'm Meg Terrell.
It is time to take a look at some of today's upgrades and downgrades. Dow component Procter & Gamble was downgraded to hold from buy at Jefferies. The analyst cites rising commodity costs and is predicting that the company will report earnings below expectations next fiscal year. The price target is 79. The shares fell more than 1.5% to 77.86. Shares of Anthem were upgraded to outperform from market perform at BMO Capital. The analyst cites the company's new CEO and the potential for stronger earnings growth. The price target is $290. The stock was up more than 2.5% to $248.69.
Capital One Financial was upgraded to outperform from perform at Oppenheimer, with the analyst citing an improvement in credit card delinquencies there. Price target now $113. That stock rose nearly 4% today to $96.56. Michael Kors was rated a buy in new coverage over at HSBC. The analyst says that the stock's current valuation is too low to ignore. Price target now $88. That stock rose a fraction to $67.39.
Still ahead, going to extremes, what one state is doing to attract workers and alleviate the shortage that's hurting some businesses. American homeowners are sitting on more equity than ever before, but they're not taking advantage of it. Diana Olick explains why.
Home values today are skyrocketing, which means homeowners have a growing amount of cash at their disposal. So-called tappable equity is the amount your home is worth above the 20% cushion most lenders require. It grew by 7% in the first quarter of this year compared to the previous quarter, according to Black Knight. That is the largest single-quarter growth since they began tracking it in 2005. Homeowners now have a collective $5.8 trillion in tappable equity, the highest volume ever recorded. Boil it down to the average homeowner with a mortgage who has gained $14,700 in tappable equity over the past year and has $113,900 available to draw. But fewer are doing that.
I think the typical American doesn't have that level of awareness. They're not probably studying the numbers.
Home equity lines of credit, which are second loans to pull out cash, were flat at the start of this year. And for those who are using them, the amount of cash they're taking out is at a 2-year low. More people are actually doing cash-out refinances on their first mortgage, which doesn't make a ton of sense because interest rates are higher today than they have been in several years. So people would be losing a rock-bottom rate they already have in order to refi. But most primary loans are fixed rate, while home equity lines are not.
Who wants uncertainty when it comes to monthly finances? I think a lot of Americans look at what are my payments, what are my incomes coming in, what are my payments going out, and wanting certainty around I can cover my costs and not worry about it.
Homeowners may have new wealth, but they also have long memories back to the last housing boom when homes were used like ATMs. And we all know how that turned out. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about Diana's story and other housing market trends, head to our website, nbr.com.
Now, we told you on Friday how the economy created more jobs than expected last month and how employers are still having a hard time filling open positions. Well, some states, which always battled each other to attract business, are now taking extreme measures to attract workers. Scott Cohn has an example.
It's dinner time at the Four Quarter Restaurant. The most important meal of the day because it's the only meal when they're open.
So the only thing that's holding you back is not being able to find people.
Absolutely. The idea of trying to open more services here, it's not even, we can't even barely staff our dinner service.
The Four Quarter is in Madison, Wisconsin, but it could be in almost any other state. The Labor Department reports 6.7 million job openings nationwide, more openings than there are unemployed people to fill them. In especially short supply, skilled workers, whether on computers or in kitchens. It's really bad in Wisconsin with unemployment at historic lows, and that's before the giant Foxconn plant now under construction that's supposed to add 13,000 jobs. So Wisconsin is targeting Chicago millennials.
An hour commute or an hour with friends? In Wisconsin, the average commute is less than 22 minutes.
Healthcare executive Patrick Cunningham and his wife made the move 3 years ago.
I had a misconception about Wisconsin. It's like beer and cheese. That's farming, maybe. That's all people think of.
State officials know it will take more than flashy ads.
Really trying to eliminate that skills gap. Investments from K through 12 schools to our technical colleges, to even putting training facilities in some of our correctional institutions.
For its part, Foxconn says it's working with its government partners and other stakeholders in Wisconsin to make certain that it has the workforce that it needs. The company wouldn't say whether the labor shortage is affecting its timelines. For Nightly Business Report, I'm Scott Cohn.
The biggest sale on Groupon may be Groupon. That's where we begin tonight's Market Focus. Recode reporting that the e-commerce platform has been in contact with a number of public companies to gauge interest in a possible sale. Alibaba and IAC are among the potential suitors. Wall Street liked that news, sending shares higher by more than 10% to $4.83. Acadia Pharmaceutical was pressured after an investigative report questioned the safety of that company's only drug. The report from the Southern Investigative Reporting Foundation also questioned the company's sales practices and alleged that Acadia used regulatory loopholes to get the Parkinson's treatment approved. As a result, the shares fell nearly 7% to $16.63. Consumer products company Helen of Troy said stronger international demand and a rise in e-commerce sales helped overall results top estimates. The company behind Dr. Scholl's and Vicks also said it expects earnings for the year to beat analyst targets. The shares rose more than 12% to $114.85 and hit a 52-week high.
Snap may be teaming up with Amazon. A report from TechCrunch says that Snap is developing a feature on its app that would allow users to take a picture of an object and then be directed to an Amazon listing to make a purchase. Snap shares rose nearly 1% today to $13.65. Meanwhile, shares of Amazon were up more than 1% to $1,739.02. And J.M. Smucker is saying goodbye to the Pillsbury Doughboy. That company is selling its U.S. baking business to a private equity firm for just under $400 million. That unit houses the Pillsbury brand. Smucker wants to shed its less profitable businesses and invest instead in faster-growing coffee and pet food segments. Shares were off a fraction to $110.91.
The share of older workers ages 55 and up who are either working or looking for work is higher than it was a decade ago, and even higher than the beginning of the Great Recession. That's according to the Labor Department's June employment report. Many older workers may want or need to work longer, and research shows that doing so could boost their retirement income even more than increasing their savings. Our senior personal finance correspondent, Sharon Epperson, is here to explain why. Good to see you, as always, Sharon.
Good to be here.
So a lot of people worry that they aren't on track saving for their retirement. If they even add a little bit to the pot, why would working longer perhaps be more additive?
Well, it's really interesting. A study came out from the National Bureau of Economic Research that showed that even if you add an extra % a year for 30 years in terms of your retirement contributions, you're still going to come out much further ahead if you work longer by just 1 year. They took someone who wanted to retire at 66, and they saved, instead of 6% a year in their retirement contributions, they saved 7%, 1% more for 30 years. That increased their total retirement income by about 2%. But if they worked 1 year longer and retired at age 67 instead of age 66, that increased their retirement income by nearly 8%, wow. 7.75%. Most of that comes from Social Security.
It's a huge difference.
It's a huge difference.
What about drawbacks to working longer, Sharon?
Well, there are drawbacks to working longer. One of the biggest benefits, of course, is that your retirement contributions are going to be able to add to them, and they can grow longer. You're going to get increased Social Security benefits. But the drawback is that if you do want to get perhaps a part-time job or want to work longer, many older workers, the recent Labor Department report also found, are unable to find the type of jobs that they may need to work longer to make it worth their while. Yeah. So many Americans depend on Social Security for a big part of their retirement income, and working longer would allow them to increase that benefit, but then they really can't find the jobs that will allow them to increase it enough to get a sizable Social Security benefit.
What if you're not in great health? You're not able to work, you can't find a job, as you mentioned, that kind of suits your particular circumstances. What can you do now to help your retirement goals be met?
Well, if you can, the most important thing you can do is to max out your retirement contributions. And if you're 50 or older, you can contribute $24,500 to your 401k, $6,000 to an IRA, and you need to invest that money aggressively, perhaps more aggressively than you think, because you may be retired for 20 years. So a lot of that money has to be in the stock market. And the other thing to consider is how much money will you be getting in your Social Security benefits? If it's $1,000 a month or a bit more than that, maybe you get a side job that allows you to earn that much money so that you can work longer and not have to take those retirement benefits early. Again, just increasing it and working 1 year longer can increase your retirement benefits from Social Security by 8%. That's a guaranteed return.
Right. One more year.
One more year.
All right, you got it.
Thanks, Sharon, as always.
Sure.
Sharon Epperson.
Coming up, it's the final straw for Starbucks, that is.
Starbucks has decided to go strawless, adding its name to the list of major brands that are ditching plastic straws in the name of sustainability. Kate Rogers reports tonight for us from New York.
By 2020, the green plastic straws synonymous with Starbucks iced coffee will be a thing of the past. The company plans to eliminate single-use plastic straws, just as demand for cold beverages climbs. Cold drinks now make up more than half of Starbucks' beverage mix in the U.S., an increase of more than 35% from 5 years ago.
Starbucks has designed this. It's a recyclable, strawless plastic lid available in 8,000 locations in the U.S. and Canada right now. These lids will be phased in as the company phases out some 1 billion single-use plastic straws per year from its 28,000 stores around the globe.
I think it's a good thing. I think they should get rid of it before then.
It's going to be really bad because I'm always wearing lipstick and makeup and stuff, and it's just much more convenient.
I'd say it's a good thing. I mean, you hear a lot about straws being not so great for the environment. I think everyone just grabs them out of habit. It's convenient.
Straws made from alternative materials, including paper, will be available for Frappuccino drinks and upon customer request for other beverages. The company has not detailed how much the move would cost to implement. Starbucks is the largest food and beverage retailer to make a global commitment to eliminate straws. Following the coffee chain's announcement, hotel giant Hyatt said it would also eliminate plastic straws and drink picks. And McDonald's has plans to phase out plastic straws in the UK and Ireland and is testing alternatives in other markets. The change is part of a bigger corporate, eco-friendly push. McDonald's made a commitment to cut its greenhouse gas emissions and to make its consumer packaging from renewable and recyclable materials. Chipotle has vowed to cut its landfill waste in half, and Dunkin' Donuts is doing away with its foam cups. Cities and municipalities are also tackling single-use straws on their own. Starbucks' hometown of Seattle banned plastic straws just last week. For Nightly Business Report, I'm Kate Rogers in New York City.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.